Let's begin with a look back at Wall Street analysts' initial predictions for the stock market's performance in 2024. To create some context above where the economy stands today, let's start by examining where we stood 2 years ago in January of 2023. At that time, monetary policy was tight, inflation was elevated, and higher interest rates were dragging down the housing market. 7 of the 20 indicators were red, and the rest were neutral, with no green to be seen. There was widespread belief that recession was imminent. No one knew if the Fed would adjust rates, if the labor market would remain resilient, or if consumer spending would continue to hold firm. In short, the outlook was murky. Now, let's take a look at January 2024, 1 year ago. Notably, monetary policy, consumer spending, corporate profits, inflation, housing and mortgages, interest rates, the yield curve, and the leading economic indicators are now all neutral. In all, 17 of the 20 indicators are yellow, while the remaining 3, international economic outlook, equity market valuation, and geopolitical risk, are red, but still no green. As we look where the economy stands now, nearly half of the 20 indicators are green. Among them are monetary policy, the labor market, and inflation. Consumer confidence has grown, corporate profits are up, and business outlook spending is positive. 9 indicators remain neutral, while only 2 remain red: equity market valuation and geopolitical risk. Let's examine one of those speedometers more closely, the leading economic index, known as the LEI. This index includes 10 components, ranging from stock prices to manufacturing orders. This data may give a clearer view of where we are when examined together. As this chart shows, the outlook has trended lower since early 22. The LEI has been accurate in anticipating the 3 recessions since the year 2000. However, it appeared to signal a recession for 2023 incorrectly. In fact, GDP growth rose even as the LEI was painting a weaker economic picture. In November 2024, the LEI posted its first monthly gain in over 2.5 years. It's too soon to tell if the upward trend will continue in 2025. However, the Conference Board, which published the LEI, cites a number of factors that underscore the indicator's direction, including a rebound in building permits, higher stock prices, improvement in average hours worked in manufacturing, and a drop in initial unemployment claims. So while no economic indicator is ever 100% perfect in predicting the economic future, the LEI remains an important input into developing our views about the economy in the coming months. Remembering that past performance may not lead to future direction is important, but as we review the charts like these, history can help suggest where we are in the economic cycle. It's also important to remember that forecasts are based on assumptions and subject to revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations as you see them expressed. Geopolitical tensions are always a concern and are often an unpredictable headwind in the economy. The ongoing Ukraine war and Middle East unrest are just 2 examples that threaten to unsettle financial markets. Another possible headwind is a resurgence in inflation. While the latest consumer price index reading has been between 2 and 3% in Q4 2024, any change in momentum may be a concern. If inflation does resurface in 2025, that may influence how the Fed approaches interest rate adjustments. Another possible headwind is labor market weakness. While this has taken a back seat to inflationary concerns, keep in mind the Fed has the dual mandate of pursuing the economic goals of maximum employment and price stability. In the second half of 2024, the Fed shifted its focus to the unemployment situation and away from inflation. The labor market will be in an area to watch in 2025 for sure. While recessionary fears did not materialize in 23 or 24 as many feared, there is some concern about economic slowdown in 2025. Consumer spending, corporate earnings, global economic weakness, especially in China, and the labor market risks are all necessary pressures to keep an eye on. There are a number of potential tailwinds that may support the financial markets in 2025. One possible tailwind is artificial intelligence, or AI. While AI was a steady influence in 2024, some see continued interest in AI throughout 2025. There are a couple of reasons. First, AI-related concepts have more room to broaden out across the economy. While most of 2024's AI was driven by tech companies, in 25, many expect advances in industries outside of Silicon Valley. Second, if AI turns out to represent a quantum leap akin to the Industrial Revolution, there may be a lot more room for growth. especially if AI drives productivity. Another potential tailwind may come from a jump in the form of improving corporate profits as companies across all sectors and industries embrace AI. It's hard to think of tailwinds without thinking of the Federal Reserve and its shift to monetary easing last year. As the effects of looser money supply continue to filter through the economy, Fed policy could be a potential tailwind in 2025. Before discussing the 2025 forecast, let's examine this chart to see where stock prices trend against historical averages. The most common way to do this is to look at the PE, or price to earnings ratio, which measures investors' willingness to pay for a company's earnings. Looking at the dotted line in the middle, you can see the PE ratio for the last 30 years is, on average, 16.9. You can see that the PE moves quite a bit, with a peak near 1999 and a trough in 2008. The chart shows the PE ratio over 22 by the end of November. Does that mean stock prices will head lower or climb in the months ahead? While PE of 22.2 is more than one standard deviation above the 30-year average, it's still a difficult question to answer. But it's fair to say that past performance does not guarantee future results, and the return and principal value of stock prices will fluctuate as market conditions change.